What is up, everyone? This is Warren Howe. Hope you're having a great day as always. Now, we are in bear market territory yet again, guys. Come on, right? Nasdaq is at 21% from the highs. I'm looking at the futures; it's getting better, but it's still 21%. It's down, still down 21% from the highs. So, what do? Right? Should we freak out? Should we sell all? Should we buy more? What is our portfolio strategy? What is the important question moving forward from here that I personally think we should consider before we buy any stock or even sell any stock? And this is, we are here to discuss options, right? It's going to be a very constructive video today that I want to put up with together for you. So before that, appreciate it, guys, if you can smash the subscribe button, right? Very appreciate it if you do. I noticed a lot of you like my LAC thesis, which is great. I love it. I love you guys. I'll be producing more and more content over that, right? And good thesis on, we've done good thesis on Oxy, Upstart, SoFi, Tesla. I'll be doing more and more of that, right? These are companies that I'm personally bullish in, and I give my reasoning. So yeah, appreciate it if you can subscribe if you haven't, and smash that like if you enjoyed this video. Now, the important question that I think we need to ask ourselves is, and imagine, this only complies if you have faith in this asset class, right? Stocks, equities. Because equities, in my opinion, has been doing wonders for me. My own net worth has been growing like crazy over the years. And if you believe in this asset class, then great. We can what we call dollar cost average, right? So if I could give you two stocks to dollar cost average on every month or every 6 months or every 3 months for the next 10 years, what will these stocks be? Yeah, that's the first question. The second question will be whether or not this stock will go down under, which is go bankrupt, if a recession hits. Now, we can't lie to ourselves. The risk of a recession is up greatly than, obviously back in 2020 and 2021, simply because of rising inflation. Yep. If they don't cool this off, interest rates remain high, expansion and growth remains slow, asset prices are high, and income does not keep up with it, a recession is very probable. Now, why am I asking these questions? This is the perfect time. Don't be like, the herd, okay? Don't lose interest in this asset class simply because stocks are going down. We must be contrarian investors and thinking, the opposite by pivoting, right? And utilizing our liquidity, utilizing our cash, utilizing our time to build thesis on stocks so that we can actually dollar cost average on our solid winners. Now, I'm not talking about solid winners in terms of stock price. I'm talking about growing fundamentals, which we're here to discuss, right? So again, back to question one. If I gave you two stocks, what will be the stocks that you want to DCA on in a 10-year period? Now, I want to share a little bit about this, right? I have a Discord group. Again, it's free. If you want to join, feel free. I'll link the link in the description down below. And, I asked a question to all of our members, right? 200 plus members, very small group. I asked, just do an emoji vote, right? We got a couple of solid stocks here. If you could choose two stocks or sectors to DCA on a compound over a 10-year time frame, what would it be? So we got Tesla, Google, Microsoft, Amazon, Palantir, some Malaysian stocks, Bursa, banks, SoFi, Square, Disney, EV value chain stocks like lithium, nickel, whatever it is, right? The tin, whatever is needed, semiconductor stocks. And majority actually chose Tesla, right? Two of them was actually Tesla and Google. Well, it's actually Tesla the most because, we are a bullish Tesla group. And semiconductor stocks was the second. Well, not really. SoFi was the second. But anyway, my point is, my personal two stocks to DCA on, I know it's boring, but, it's Tesla and Google. Now, when we want to ask ourselves this question, we can't take it lightly. Before we execute, we can't take this lightly. Why? Because when you want to add in more of your hard-earned money over time, again, you are thinking if you can get 5,000 every month or 3,000 and just pile onto these stocks, it is not, it can't be taken lightly, right? We are actually utilizing our hard-earned money and just be compounding on this asset, right, over time. So there are a few questions that we should think and branch out before we, execute, right? Buying and selling is so easy. That's what people are taking advantage of. But owning a business is difficult because we really need to put our blood, sweat, and tears into the thinking process and just be saying, okay, I want to own this stock for 10 years, right? Now, Tesla and Google, why? There's a couple of reasons. Number one, the first reason that I chose Tesla and Google, obviously, is because in the life cycle, in the S curve, every company has an S curve, right? We want somewhat of a stability. So right now, if a recession hits, and it's likely to hit, there will be companies going down under, right? We can't get away from that. There'll be companies going down under, and I'm very bullish on SoFi, right? I'm very bullish on Tesla, Palantir, Upstart, Oxy, and all these stuff plays. Not really Oxy on a longer term time frame, but anyway, you get the drift. So there's no doubt that some of these stocks, or even ARK Invest stocks, will go bankrupt in a recession. So think about it. When I talk about S-curve, and that was the first thing that I consider when we want a DCA, S-curve will tell us we want somewhat of a stability, and Tesla has that. They are pioneer in the EV space. It's a good product market fit. If you want to compare company car metrics, right, just car company metrics, I said this before in a previous video, check it out, then they're already doing better than car companies. Now, Tesla doesn't have a demand problem. Tesla has a production problem. So that is something good of a problem to have. And if you want to talk about stability, again, they're already in the S&P 500. They're already considered a big market cap. They have huge demand, 50% CAGR growth, whatever it is, right? It's all there. So that's number one. It's a no-brainer play in my opinion. If you guys still don't have Tesla in your portfolios, do consider. Why? Because Tesla is trading at 67 to 70x PE right now based on Q1 annualized earnings. Yep, Q1 annualized earnings. So Q1 2022, they had 3.3 B in earnings, net income. If you just simply times 4 and annualize that, we can derive, and versus their market cap, which is around 900 B right now, we will get, 70 PE. And of course, we talked about this before, expect a 4 to 5% haircut of total revenues because of the 30-day Shanghai Gigafactory shutdown. But it will be offset with the new deliveries from the new Gigafactories, right? But all in all, if we just don't factor in growth, analyze it, we are looking at a 67 to 70 PE for Tesla. Now, if the stock market tanks more, and that's better for us because we arrived to the decision to dollar cost average. Again, we'll be accumulating shares at a cheaper price. If a recession hits, and the S&P 500 goes down 50%, like what they did in 2008, we will probably look at Tesla at, $400, $500 per share. And if we have done our back of the envelope valuation by 2024, 2025, how much are the revenues versus net income they'll generate? If that number makes sense to you, then again, it's a good time to add another tranche and DCA on. And that's what this exercise is. We need to be constructive right now and just be thinking, okay, if a recession hits, regardless of the market, we'll still be adding more and more shares, right? So 2022 to 2023, in my opinion, are the years of accumulation. We need to accumulate more shares rather than distribution, right? Hope that makes sense. So again, that's number one. Looking at the S curve, where how much growth do they have? They provide somewhat of a stability and cushion because of all the progress that they have had. They do not need to depend on, borrowed money anymore from outside. Their balance sheet is strong, really strong. Look at the balance sheet, right? I'm saying this again. Total assets 66B, total liabilities 30B. Now, I don't even have to, I went through this before in the previous video. Check that out. But looking at shareholders' equity itself, it's strong, right? 34B shareholders' equity. Stockholders' equity. If you want to assess the cash burn, they're such a lean company, right? Net income is already positive. We don't need to say much. Demand is not a problem, all that. So again, that's why number one should be my Tesla, one of the stock for my kids to DCA on over a 10-year time frame. My second one is Google. So, Warren, you're boring, right? Why Google? And again, it comes back to my number one, right? My number one point on S curve and stability, right? So you think about it, 2020 to 2021, Google had 40% revenue increase. How many growth stocks can do that and still be net income positive with a 29% profit margin? Again, we're talking about constructive, right? We're not plucking figures out of the sky. Google, based on their growth, now Q1 is they're buying back shares. Okay, they have excess cash, they have surplus of cash, they're buying back shares. Realistically, they're actually giving a 4% value for existing shareholders by diluting us, right? Sorry, not diluting us. Basically, a share buyback is good for us, right? But my point is, they're having a forward PE of 17, and this is where all the deals in the market, we need to be questioning whether or not we should take it, right? So we're looking at a monster of a company, $1.6 trillion, right? Growing at 40%, having a insane market fit. YouTube is still going to grow. In a year, YouTube has grown 4 times based on their, recent transcript, right? Check out the earnings call. It's not bad as what Wall Street is actually saying. It's really good, right? Forward P of 17, 70B share buyback, market cap 1.7B. This stock is insane. Now again, it comes back to stability, right? I don't even need to look at the balance sheet. Check out the debt to equity. It's close to 0, right? Long-term debt to equity, 0, right? Why? Because they have plenty of cash. They have low debt. 29% profit margins, that's insane. So again, brings back life cycle. They're providing stability. There's cushion. That's number one. Number two, before you decide you want to go on SoFi or Palantir as your 10-year stocks to DCA on, what is the cash burn, right? What is the cash burn? If you look at SoFi, yep, and I'm very bullish on SoFi, right? I'm already down 50%. I'm not ashamed to admit it, but then again, what stocks are not, right? But yeah, I'm down 50%, but I'm still okay because I'm looking at the cash burn, right? I'm assessing how much they're burning in cash. If they go down under, now again, if a recession hits, they might go down under simply because of loan volume. They're highly dependent on a single loan, which is personal loans right now, just to keep afloat. So the 900 net revenues are dependent on, obviously a mixture of loans, but majority of personal loans. I'm factoring out 0 on student loan refi because they extended again on the moratorium. But we have to really assess their breakdown in terms of revenue. And if loan volume gets little because interest rates go up, and during recession, no one wants to spend money, no one wants to borrow. Well, they need to borrow maybe, but the loan volume will definitely be less. But my point is, can they maintain 1.5B revenues, 984 revenues? This is a gap basis, by the way, and assess how much cash burn are they burning. Now, obviously, OPEX during a recession, if their sales get hit, their operating expenses will decrease as well because they have to lay off people, right? But again, we have to assess what is the cash burn a month for the year or the year. GNA 498. You take a 20% shave off because they have to lay off people. At the end of the day, how much do they have to spend for the whole year? Right? I take that amount. I look at the balance sheet, and I assess how much cash do they have. Right? They have strong in loans, right, and little in debt. So that's the good news, right? Because the loans are basically what people owe them as loans, and how much they have to actually pay off the partner banks, which is 3.9B and whatnot, all consolidated debt. So they also have high debt actually for this size of a company. So it's only a 5B market cap right now. 6B market cap, right? But their assets are strong, and we get the net shareholders equity still strong, which is at 4B. But then again, that will decrease as soon if a recession hits, right? Lesser loans, but the most important thing is, can they keep the company afloat to ride off the tough time to survive, right? And this comes back to the number one that we talked about, S curve. They're way down in the S curve, so there's more reward, higher risk, obviously. They're not as stable, right? Their balance sheet looks good. Their income not exactly that sexy because they're not profitable yet. So those companies that are not profitable, doesn't have the path within more than 2 years, I'm out, because they might go down under simply because of that. If you want to further do a stress test on your companies, assess their liquidity, how much they can actually borrow from the bank, how much can they raise to pay off debt versus the cash burn that they can have. If they can last more than 3 years, then go ahead. But then again, these are, again, we want to do something constructive. We look at balance sheet, cash in the bank is not exactly as sexy versus how much they're burning for the year, right? Their loans are sexy because it's 6B versus the debt that they owe, so you got net of 4B, which is great. But again, during a recession, everything goes lower. So we have to see what is the progress of SoFi, right, this year, and how much they can they keep up to, even though with a headwind of no student loan refi, can they keep up with what they projected, the guidance, right? 50% up on revenues and whatnot. So these are things to consider. Now, the second question is, what is the worst case scenario? And oh, by the way, I missed out CAPEX, right? What is the CAPEX that they actually have to spend? So we got property, equipment, and software. We want to make sure that this is not too high because the net income that is actually gotten doesn't go burnt in, and spent or inventory, right? It's spent on those and, stuck. This is not exactly inventory. This is just, the amount that is needed to keep the company competitive and maintaining. We need to make sure that this is not, a big amount so that they can actually survive, right? So we say a couple of good things, right? So number 2 will be, what is the worst case scenario in terms of revenue projection? That's what we need to answer here. If you have worked out all of these, then we would actually eventually get a very good conviction of your companies before you decide to DCA on these companies, right? So for example, if Palantir is still losing money, right, in a quantum, and they're still burning cash, if the liquidity, if their revenues don't grow as much as expected, can they still survive? Now, we already worked out the cash burn, assuming that you work out the cash burn a month or the whole year. Now, again, you have to work out the worst case scenario of how much revenues they can actually grow during a recession. Yeah? So think about it. These are questions that we need to ask ourselves for the companies that we own, and we have to act before. We have to be constructive and just ask ourselves whether or not they can survive if shit hits the fan, right? So 2 questions: what are the 2 stocks that you will DCA on in a 10-year time frame? The second question: can they survive during a recession? Because that's very likely and more probable. And to answer that, look at the balance sheet, look at the cash burn. Look at their revenue projections in the worst case scenario. What is the net income margins they can actually get? If it's a losing money company, which I know a lot of us own since 2021, then can they actually survive in a 2-year period versus the liquidity and capital resources they can raise, right? So again, I hope you got some value out of this today. Think about the deals that we talked about, right? Google is trading at forward P of 17. It provides stability. Tesla is trading at, Q1 annualized earnings of 70 PE. Growth companies can't even have that right now, 50% KAGR. What are the stocks that you want to own? What are the 2 stocks that you want to DCA on in a 10-year time frame for your kids? And we can't just take it lightly to say, okay, Palantir, SoFi. No, we have to do constructive thinking, constructive analysis, doing our homework, and just be piling on the thesis. Right now is to raise cash. Liquidity is king right now. Raise cash, build thesis, be in a position of power, and join our group. Join our Discord. It's for free. Right, the link is below, and hopefully you have a good one. Thank you. See you in the next video.